Hello and Assalamualaikum. My name is Firdhaus bin Azmen and this is my investment proposal on how I would invest 1 million US dollars internationally. In this presentation, I will explain about my portfolio allocation, why I selected Spain, Denmark and New Zealand, and how I balance growth, risk and expected returns. So, my investment objective is to create a portfolio that balances long-term capital growth and short-term opportunities and also risk management. To achieve that, I diversify across 3 countries with strong fundamentals, which are Spain, Denmark and New Zealand, with an additional of 10% in cash for liquidity. So the total allocation is 50% for Spain, 20% for Denmark and 20% New Zealand and 10% cash. This structure gives me exposure to different economies, sectors and currencies. Spain takes the largest portion at 50% because the country offers both long-term growth and short-term yield potential. For the 20%, I split my investments 50-50 between government bonds and renewable energy stocks. For the short-term 30%, I allocate 30% treasury bills and stocks 50 ETF, which is highly liquid and suitable for short-term trading. And Spain currently shows strong economic recovery momentum, high investment in renewable energy, and attractive short-term yields. This makes Spain ideal for both stable growth and achieved short-term positioning. Moreover, Spain offers the best short-term opportunities among the 3 countries. Spanish T-bills provide strong yields and the equity market is more liquid, allowing faster entry and exit for short-term strategies. This is why only Spain carries a short-term allocation, while Denmark and New Zealand remains purely holding the long-term holdings. New Zealand is a safe, stable, long-term investment environment. The country has strong governance, a transparent policy framework, and low corruption. Their monetary policy is credible and inflation is well managed through the Reserve Bank of New Zealand. New Zealand also has strong trade advantages with the Asia-Pacific region, where you can see my NZ allocation is split equally into 50% REITs and 50% government bonds, giving me steady income and diversification into the property sector. Denmark is another strong long-term market driven by world-leading industries like pharmaceuticals and wind energy. The country has very stable political and regulatory conditions which reduces risk. Its currency is tied closely to the euro, which is maintaining stability. And my Denmark long-term allocation is split into 50% in Denmark's ETF and green bonds 50%, focusing on sectors that support long-term growth and sustainable growth. There are 3 key risks in this portfolio. The first one is market volatility risk, fluctuations in equity and bond prices. Second is currency risk, USD movements against Euro and New Zealand dollar. Lastly is interest rate risk, especially for bond-heavy positions. To manage this risk, I use 3 hedging strategies. The first one is diversification across multiple countries and asset classes. Second, a balanced equity bond mix, especially in long-term Spain positions. And lastly, maintaining a 10% cash reserve, which protects the portfolio and provides flexibility to buy during market dips. For short-term investments in Spain, I expect returns between 3% to 5% per year because of T-bill yields and tactical ETF movements. For long-term holdings in Spain, Denmark and New Zealand, I expect 6% to 8% annually, driven by stable developed markets and sectors like renewable energy and property. As a whole, my overall portfolio is expected to generate 5% to 7% annually, which aligns with a moderate risk global investment strategy. In conclusion, my 1 million USD portfolio is strategically diversified across Spain, Denmark and New Zealand to balance growth, stability and liquidity. The mix of long-term equity and bonds, short-term opportunities and cash reserve ensures controlled risk with consistent potential returns. Overall, this approach is designed to provide sustainable, stable and well-hedged returns over time. Thank you for listening.